thanks so much for being here.
Sure, great to be here.
Welcome to Spain, welcome to Madrid, and welcome to Azvalor and Azvalor Managers.
Yeah, great to be here.
As we have a limited time, Pavel, I'm going to try to be as executive as possible. So I'll start with a probably more general question about your background. So you've been kind of an overachiever during your entire life. You started as an entrepreneur at a very young age. You moved to the US. You started your own investment company. So kind of the American dream in a way.
Right.
So maybe you can walk us through that period, how you kind of got interested in investments in the first place, and how you kind of saw or lived through all those years when you were kind of building up 3G Capital.
Yeah, sure. So basically, for as long as I remember myself, I always wanted to be a capitalist entrepreneur, despite growing up in what was back then a communist country. And when the Soviet Union split up, Belarus became independent. Basically, business opportunities sprang up, and I started, getting engaged in different ventures ever since I was like maybe 11 or 12. At first, I was selling strawberries at a local market. Then I started selling advertising space in local newspapers. Then I started selling rebars to reinforced concrete manufacturers, and finally, I started an accounting magazine. So all of those businesses were interesting. However, they were not really scalable, and I was looking for something different to where I could sort of make it global, and basically something where I could learn something new every day. For that, I felt I needed to come to the U.S. So I applied for and won a scholarship sponsored by the U.S. government, awarded to the best students in Belarus. So made it across the pond, ended up at Western Kentucky University. And this is where I sort of got exposed to value investing through learning about Buffett. I basically was sort of searching for a business that I could be engaged in for the rest of my life. And as I was going through the list of the richest people in the U.S., it's sort of like what Buffett said resonated with me. Seemed like that was a good fit for my personality. And I started exploring value investing. So I thought, there'd be a fit. And made a lot of sense to me, so I put together a small portfolio based on value investment principles, and later on that was the foundation upon which 3G Capital was built, and that was in the late 90s. That was actually at the height of the dot-com boom, and I think I was the only teenager buying old economy stocks at 4 times earnings. All of my peers, and actually even people much older than me, they were buying like all those new age companies, high tech, were making money but selling 30, 40, 50 times earnings, or maybe not making any money at all. And at first I was losing money versus the market. I think the first year I was down maybe 15 or 20%. The market was up in the double digits. I looked a little dumb despite doing the right thing from the get-go. However, within a 3, 4, 5 year time span, I've done way better than the market, which again, that's sort of the lesson is that, when it comes to investing, that 1 year doesn't really matter. You have to focus on the 3 to 5 year time period, because that's really going to tell you the story.
So you had this kind of inoculation of value investing, as Buffett puts it, that's either takes you in the first place or will not take you ever.
Exactly. It's either right away or never.
Maybe you can discuss a little bit how you met your partner, Corey, and how you kind of work in a kind of day-to-day basis with him in terms of the workload, in terms of going after companies, doing research, etc.
Yeah, sure. So basically how we met, we both worked at a traditional money management firm based in St. Louis, Missouri. They ended up putting us in the same office, and basically we started talking about investing. And what we realized that our passion was running money in a slightly different way versus the majority of the value, or of the traditional, I should say, money management industry, because on average, the average money manager is sort of in the asset gathering mode, and we wanted to start a firm that'd be more focused on producing returns as opposed to asset gathering. We thought there was a space to do it. This was something we were passionate about. So we basically ended up going out on our own. And, we went to our boss to inform him, and, Ironically, even though I didn't think someone who is sort of working in the traditional money management industry would be willing to trust somebody who wants to do value, he became our first client. So he actually wrote us a check. He's a happy client. He's been with us since day one, made good money. So he's not unhappy.
Yeah.
So that was 2004. So that's when 3G opened doors. And in terms of the process, I think when you think of how a research process is set up, you have to think about airplane safety. So if you look at the improvements in airplane safety over the years, the reason that it's so safe to fly today is because you have redundancy built into the system. So every system has a backup system, and even the backup system a lot of times has a backup system. And so that's how Corey and I structured our research process. So what we basically do is run our processes independently as to make sure that there is redundancy when it comes to investment discovery. So if I were to find an investment idea that I thought looks interesting, I'm not going to tell Corey anything about it because I don't want him to be influenced by my thinking. Mm-hmm. What I'm going to do, I'm going to basically go through the entire research process from letter A to letter Z, talk to my own sources, et cetera, and if at the end of the process I come up with a buy recommendation, I'm going to talk to Corey about it. I'm going to tell him, look, here's a company, I think we should buy it. Well, then what he would do, he would go through his own process of research from A to Z using his own sources completely independently of my work. And then at the end, we're going to compare notes and we're going to see if we end up on the same page. And to the extent that we do end up on the same page, we make a buy decision. If we don't end up on the same page, well, then we try to see where the disconnect is. Maybe, we're dealing with different data sets, or maybe we slightly different the analysis or whatnot, and then, we see if we can come to the consensus. But, it's always data-driven. Mm-hmm. So it's not a gut feel. It's sort of like, we line up the data, and, to the extent that the data are right, well, then you're going to be making a certain decision.
Okay. And in the early days of your firm, you were focused mostly on U.S. names. You decided to change that in around 2009. I'd like to ask a couple of questions there, like why you decided to do so, and when you invest in more, apparently more risky countries, emerging markets, frontier markets, how do you kind of assess risks like regulatory risks, political risks, currency risk? How you go about that when you are dealing with these kind of countries like China, some countries in LATAM, Middle East, etc.
Okay, sure. And just to take a step back before I answer, I don't think I met any people in those emerging markets or frontier markets that ever thought of themselves as being in emerging or frontier markets. Yeah. So to them, those markets look perfectly safe, but markets outside of their markets is what they consider emerging and frontier. So
that's a fair statement.
Yeah. So look, when we started off in the U.S., we saw a decent amount of opportunities in the U.S. And over time, we just realized that the U.S. market has gotten picked over. So the number of investment opportunities really dried up. So basically, we either had to accept a less attractive, price to value combination, or we had to go outside of our sort of usual pool of investments, which basically made us start looking internationally. Basically, we concluded that the probability of us, just statistically speaking, being able to find a high-quality business at a lower price is going to be so much higher if we enlarge the universe going from basically one country, which is the U.S., to the entire world. And besides that, what we also discovered is that the U.S. market is a lot more competitive in terms of like talent looking for ideas. If you go into those emerging markets, frontier markets, those markets are a lot less competitive. There's a lot less in a way of sophisticated long-term investors in those markets. So I think it's going to be easier to find those businesses that offer very attractive gaps between price and value. So that was sort of our initial thought process. And then in terms of managing risk, I think, we have to take a step back and realize that investing is always risky. And you can do it in the US, you can do it in China, you can do it, in Spain, Italy, it doesn't matter. There's always going to be risk. Now, of course, our job is not to avoid it because unavoidable. You have to manage it. So how we do it, we basically study those markets very closely using sort of on-the-ground intelligence gathering networks in order to minimize the risks of investing. And then the second step, once you sort of once you reduce a certain spectrum of risks, well, then what you try to do, you try to make sure that you get paid properly and adequately for the risks that you take. And then you also construct your portfolio in such a manner that any single risk that basically does occur does not bring down the entire portfolio and does not result in a permanent capital loss. So, and with that, there are different things. Just to get specific, there's, for example, confiscation risk. Like what happens if, assets get expropriated, because in some of those markets, property rights are going to be not as solid as they are, let's say, in the US. So, you have to be aware of certain things. For example, if you're dealing with strategic industries in certain countries, you have to be careful because if you're dealing with a private company in a strategic industry in those certain countries, you might have a big target on your back. So the government might eventually want it back, and you might suffer as a minority shareholder. So if you're looking at those businesses in strategic industries, well, perhaps you want to invest in a company that's aligned with the state, or maybe state-owned, or has a large ownership stake. So this way you're going to be protected. When it comes to political risk, again, you have to study management and who is behind what business, and you want to be sure that they don't have this propensity to get involved in politics. Again, if they have a propensity to get involved in politics in some of those countries, that could have dire consequences for the minority shareholders. And I've seen some cases in Russia and in Turkey, so that's another thing that we sort of just use to make sure you're not putting yourself at risk. Again, there's always some risk, but at least you try to minimize it.
Mm-hmm. And I'm thinking about your 3G approach, like good business, good management, and good price, or good valuation. Maybe touching on the valuation part of the equation, if you can explain a little bit what do you consider to be cheap, or what kind of valuations are you prepared to pay, and how do you kind of approach your valuation methodology?
Right. So again, just to step back, because I know, in this day and age, there are tons of people, including value people, saying, well, paying 30 times for an asset, could be a great price. I don't quite agree with that necessarily. If you look at the past, 50 years of history, 70 years of history, what you're going to see is that on average, the market traded at probably 15, 16 times. So, if you're paying double that, you're probably putting yourself in the line of fire, so to speak. So in our playbook, a safe price to pay would be anywhere between 4 and 11 times normalized sustainable earnings. And I'd like to emphasize that we're talking about normalized earnings rather than current earnings. And what it means is that anytime we look at a business, we try to normalize the earnings to imply the economic situation that's not too bad and not too good. So, and then we'd like to pay a multiple of between 4 and 11 times based on that. And of course, for businesses that are growing faster, we're happy to go up the sort of the multiple scale. For slow growing businesses, would like a lower multiple, but we normally end up in the 4 to 11 times range. And as a practical matter, if you were to look at our portfolio today, you would see that the price earnings ratio for the portfolio is less than 5 times earnings. And you see that the dividend yield is almost 8.5%. And now, of course, a lot of our holdings have excess cash and no debt. So if you were net out the cash, then your price earnings ratio would even be lower than the, I guess, 5 times earnings that I just quoted.
Mm-hmm. There was a question earlier about whether you could give an example of a company that would represent well how you kind of approach investments, how you manage those risks we mentioned, and how do you go about defining what a good business is?
Sure. So I don't want to name any names.
That's fine.
But there's a company in a certain country, and they're in the ERP business. And basically, a couple of things. Number one, once you're number one in the ERP business, it doesn't matter if it's Brazil, could be China, could be Romania, or could be Argentina or the US, you tend to stay in the lead forever. People just don't switch. So this specific company is number one in the ERP business. And I think in terms of competitive sustainability, it's very solid. However, in addition to that, what you see is that they generate return on capital that are very, very high, 35, 40%. They have a good growth rate. Importantly, when we're talking about the risks in those EMs and frontier markets, I think a lot of times people bring up FX risk, right? So that company is well insulated from that specific risk because some of the product that they sell is export, euro denominated, and the other part of the product is local, yet that market is global, and all the competition in that company, they price their product effectively in euros, so they're really not subject to currency risk. And of course, it's not just theoretical. If you look at their growth in revenues and profits in the past 20 years, they've compounded in dollars at a 15% clip. So, that company has no debt. They have cash, which is like 10% of the market cap. And it's selling at a very attractive price of like 6.5 times earnings. Now, you look at any other company, be it, frontier, developed, emerging market, I don't think I've ever seen an ERP company selling for less than 15 to 20 times earnings. So basically, you're selling for 1/3 of that. And historically, the company was sold for well over 15 times earnings. So, management team is good operationally. If you look at the KPIs for the business, they're consistent with the peers, if not better. They do the right things with the capital. They pay a dividend, buy back stock, and it's cheap. So that'd be one example.
Mm-hmm. And in a market environment where, as I was referring to earlier, like where we have these extremes between cheap companies and expensive companies, and some very well-known investors like Seth Klarman calling it the everything bubble. So everything seems to be expensive in the market in one way. So how are you able to find these kind of companies that are very solid and that are so cheap?
Well, and I guess this is to say that, it's not really the everything bubble. Like tons of things are expensive.
It's obviously a generalization.
Right. But I'd say, number one, our investment universe is very broad. So we have the flexibility to go into certain neighborhoods where other people perhaps are going to be a little less willing to go to. So that's number one. Number two, we have expertise that we develop in the course of being in the markets for 2 decades, and that enables us to find those unique names and unique niches that most people are really not really looking at. And as a result, we can actually find those names that combine high quality with very low prices.
Okay. I'm going to ask a question that came from the audience, so I'm going to read it just to make sure I get it right. So it says, inflation seems to be here to stay, with some data points on the interest rates curve suggesting we will have more inflation than expected and for longer. So do you see similarities with the US situation in the 70s that ended up with Volcker's intervention in 1979, raising rates to 17% and bringing the economy to a halt in order to control inflation? And how would you protect your portfolio from this kind of inflation risk?
Right. So a few things. Number one, when you talk about inflation, you're talking about the developed markets. It's not an issue everywhere. If you look at China, they're actually dealing with deflation, not inflation. And to the extent that we're globally diversified, maybe inflation is not an issue in all the markets that we'll look at.
Yeah.
But of course, something that we have to take into account when investing. And like we've dealt with that issue before in places such as Turkey, for example, or Brazil, like where they have a history of very high inflation. And the way you protect against that inflation is you have to identify those specific businesses where they can easily pass any negative impact of inflation onto the end user. So this way they're going to protect their margins and maintain that profitability. And, what kind of businesses would those be? I don't know, could be confectionery, could be beverages, so that sort of stuff. Now, if you're looking at maybe like utilities, that's going to be tougher because I don't think it's going to be easy for a utility to just basically make an automatic pass-through of inflation onto the end users. But at the end of the day, key is finding those businesses that can actually increase prices in line with inflation or maybe more without losing volume.
Okay. I got a couple of more, let's say, personal questions coming from the audience as well. I think Ignacio is asking several questions, but one that we probably didn't answer yet is whether you have skin in the game. I mean, whether you invest your own capital in your strategy. And the other one is if you can tell us something about yourself, like what do you like to do when you are not doing research on companies and money in the portfolio?
Okay, sure. So in terms of skin in the game, definitely I do. Like over 80% of my personal net worth is tied up in the fund. So to the extent that the fund doesn't do well, I probably take much more of a negative impact than anyone who's invested alongside myself. And in terms of things that I like to do on my free time, actually like do different sports. I play tennis, but even though I'm trying hard, I'm still not as good as Javier. Maybe someday. So
we played a few months ago, but
yeah, I play soccer and hockey and stuff like that. So
okay, I think we got one.
We've got a question
right
from an investor says, Pavel, isn't it excessive to have a concentration of just 10 to 20 business portfolio, even more considering that you're investing in the risky emerging or frontier markets?
Well, I think if I could find enough names that fit the 3G criteria, I'd be happy to be in 50 names. But the problem is, if I were to say I need 50 names, given how stringent we are and how disciplined we are with respect to each criteria, I mean, we're lucky to find maybe 1 or 2 ideas a year. So for us, to put together a portfolio of 50 stocks, I mean, that would just take a few decades. So.
There's another question for both of you, and it says, Pavel, you visited Madrid in 2017.
Yes.
What has changed in 3 years since then? And why, and this is a question that I guess is for both of you, why have you chosen to partner with Azvalor to the detriment of other investment firms in Spain?
You want to go first?
Well, what has changed in 3G since 2017?
Right.
Well, of course, our portfolio makeup is different, right? Because, certain names that were in a portfolio back then, they're not in a portfolio now. But if I were to look at the biggest change, I would say that if you were to look at our discount to value, 2017 versus today, our discount to value today is going to be much, much larger. Sort of like, I think our historic discount to value was about 50%. If you were to look at the discount to value today, you're probably talking 65% or so. And I think the second question was, why Azvalor?
Yeah.
Well, I think, they were interested in us and we're interested in them. So it's kind of like marriage. Like, I don't know. Yeah. How does it happen?
Yeah, I think, from Azvalor's standpoint, we've been basically doing research on Pavel for a few years now. Actually, I think Alvaro and Fernando, our co-CIOs, met Pavel probably 15 years ago, but we took our time to delve deep into the investment process. In the last, 4 or 5 years since we met for the first time, I think in New York, we've probably gone through 500-600 managers that we've analyzed to some extent or another. But rather than focusing on the track record, which we know that there are many managers out there with outstanding track records, to us, the most important thing is that the process to achieve those returns is the right one in terms of having the right long-term mindset, in terms of having deep research on companies in order to avoid permanent loss of capital and in order to know as much as you can about a given company. And I think 3G Capital's approach in terms of being long-term, in terms of being contrarian, in terms of being flexible enough to go to areas where other people wouldn't dare to go for many reasons, many of which are related to the ecosystem of their firms. So this kind of flexibility, and also being a small firm in terms of AUM, that gives you flexibility to go to companies that others, even if they want to go, they can't go because they're too big. So to us, it's kind of a perfect combination of having the right people with the right ecosystem and the right process.
Muy bien, pues si no tienes más preguntas, Javier.
Great. If you have no other questions, Javier, that concludes our presentation. Thank you so much, Pavel.
Ustedes por la
Thank you very much, everyone, for following this Azvalor Managers presentation. Thank you.